The live price for Nokia stock is currently $13.92, showing an impressive intraday surge of 8.58% as of May 12, 2026. This vertical move has pushed the stock toward a fresh 16-year high, catching many retail traders off guard, while signaling a massive institutional shift in how the market views this legacy telecom giant. While the average observer might see this as just another cyclical bump in the networking sector, the reality is far more complex and involves a deep structural pivot that has effectively turned this company into an AI infrastructure play. Investors often look at Nokia through the lens of old-school 5G towers, but the real story right now is the explosive 49% growth in their AI and cloud segments. The expectation was that the company would slowly grind through a stagnant telecom market, but the reality is they have booked over €1 billion in new orders, specifically for AI-driven optical networks. This has created a curiosity loop for those watching the charts. How did a company known for hardware handsets and cell towers suddenly become a darling of the high-frequency trading desks and serious institutional portfolios? When you look at the recent price action, it's clear that momentum has shifted from a slow burn to a full-on breakout. We are seeing heavy trading volume that dwarfs the typical daily averages, indicating that big money is rotating into these shares. In April, the company delivered a massive beat on earnings per share, coming in 31% higher than what analysts were forecasting. That kind of surprise doesn't happen in a vacuum. It happens because the market fundamentally misunderstood the pace at which AI workloads are stressing global data networks. Today's price of $13.92 reflects a growing realization that the AI boom isn't just about the chips, it's about the massive pipes needed to move that data between data centers. This is where the partnership with NVIDIA comes into play. By integrating GPU-powered intelligence directly into radio access networks, they are building a bridge between traditional wireless environments and the new AI economy. This is a far cry from the days of just selling hardware to mobile carriers. If you are using tools like the Fidelity mobile app or checking your positions on interactive brokers, you've likely noticed that the volatility in these shares has picked up significantly. On a platform like Robinhood, where fractional shares and ease of access drive retail sentiment, the stock has started to take on a bit of a meme-like quality, but with actual fundamental backing. Unlike some of the high-flying tech names that trade purely on hope, this company is sitting on nearly €4 billion in net cash. They are raising their growth outlook for network infrastructure to double digits, which is a massive jump from the single-digit estimates we saw just 6 months ago. Institutional activity shows that funds are increasing their weightings here because the stock offers a rare combination of reasonable valuation and high growth exposure. While names like NVIDIA are priced for perfection, this ticker is still viewed by many as a value play that is just now being discovered as a growth engine. Comment below how many shares of Nokia stock you currently hold, or if you are waiting for a pullback before jumping in. The current market narrative is heavily focused on the 5G rollout being finished, but that's a surface-level take that misses the forest for the trees. The reality is that the 5G cycle is transitioning into an AI optimization phase. The company's AirScale products are being used to rapidly upgrade existing networks to handle the surge in uplink traffic caused by generative AI applications. When you look at the sector momentum, it's clear that the demand for optical fiber and high-capacity switching is outstripping supply. This is a structural tailwind that could last for several years, not just a few quarters. Macroeconomic pressures like high interest rates have squeezed some competitors, but the strong balance sheet here has allowed for strategic acquisitions, like the Infura deal, which is already providing synergy benefits that are hitting the bottom line faster than anyone expected. Let's look at the actual business model for a second to understand how they are generating these returns. They operate through several key segments: network infrastructure, mobile networks, and cloud and network services. While the mobile network side is focused on disciplined profitability and 5G upgrades, the infrastructure side is where the real growth is hiding. They are shifting away from lower-margin consumer fiber products and doubling down on high-speed IP routing and optical networking for web-scale players like Google and Amazon. This is a fundamental change in the company's identity. They aren't just a telecom vendor anymore. They are a vital component of the global data center ecosystem. Historically, this was the company that defined the early days of mobile phones, but they spent years resetting their strategy to become a leader in high-performance networking. That reset phase is over, and we are now firmly in the scale phase where the investments in R&D are finally paying off in the form of massive contract wins. Looking at the future outlook, the catalysts are lining up for a sustained run, though risks always remain. The transition to 6G is already being discussed in the background, with the market for that technology expected to grow at nearly 30% annually. They are positioning themselves to be the dominant player in that space long before the first towers go up. However, investors need to be aware of the potential for margin pressure if regional softness in certain markets persist.
Geopolitical tensions also play a role, as global supply chains remain sensitive to trade policy. But when you weigh these risks against the opportunities in AIRN and the multi-trillion-dollar infrastructure boom, the bull case remains quite strong. The tension between the expectation of a boring telecom stock and the reality of an AI infrastructure powerhouse is what is driving the current price discovery. For those self-investing through an individual brokerage or managed platforms like SoFi Invest, the key is to watch the book-to-bill ratio. Currently, it's above 1, meaning they are taking in more orders than they can even fulfill right now. That's a great problem to have. As long as they continue to beat on margins and show that the AI integration is leading to more than just hype, the stock has a clear path to continue its recovery. We are seeing a rare moment where a legacy brand is successfully navigating a massive technological shift, moving from the periphery of the tech world back to the center. The recent move to $13.92 is a statement from the market that the old narrative is dead. In summary, the stock is currently trading at a pivotal level where momentum meets fundamental strength. The expectations were for a slow, dividend-focused recovery, but the reality is a high-growth pivot fueled by the AI supercycle. With a strong cash position, strategic partnerships with the biggest names in tech, and a leadership team that is executing on their long-term roadmap, the company has successfully redefined its place in the market. Today's intraday move of 8.58% isn't just a flash in the pan, it's the result of months of earnings beats and strategic repositioning. Whether you are trading on the Fidelity platform or keeping an eye on things via Robinhood, this is no longer a stock that can be ignored as a relic of the past. The gap between what the market thought this company was and what it has actually become is closing, and those who recognized it early are seeing the rewards in real time. Authority in this market comes from looking past the ticker symbol and understanding the hardware that actually makes the digital world turn. Right now, that hardware is increasingly coming from one place, and the market is finally starting to price that incorrectly. Maintain a close watch on the upcoming field trials for AIRN, as those will be the next major catalyst to either confirm this growth story or force a reevaluation of the current valuation premiums. Regardless, the narrative has fundamentally changed. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell notifications for more updates.